Hello everyone, hope you're doing alright. Welcome back. Yesterday in the previous video we talked about draw on liquidity. We also took the bonds as example in the previous video. Now we're going to add on to that with the willingness of price and how to react in price and how to react to price instead of predict. As traders we're always taught to react to price and not to predict, but how do we actually react instead of predict? So as we saw in the previous video, we mentioned this monthly SIBI, we expect price to go lower, potentially take out this low on the monthly. Then if we drop down into the daily, we mentioned this sweep. Now, how do we know that this is a sweep? Because for me, I wouldn't have guessed that we just traded back up here, sweep the high and then continue lower. I had no idea, but I did react to it and I saw it happening. So ask yourself, what is the current draw on liquidity? The current draw on liquidity was this monthly low. So our draw on liquidity is on the bearish side. If the draw on liquidity is on the bearish side, we want to see some indication that price wants to go lower. Now, how can we get this indication and how can we react to it? Once we traded above this high, if price wanted to trade higher, if price was willing to go higher, what should have happened? Price would have likely done something like this into the daily busy here and continued higher. It would have respected the order block like it did here, and it wouldn't have retraced back inside the range immediately and so far deep into the order block, disrespecting mean threshold as well. Because as you see here, there's conviction going higher. We retrace, we reject immediately off of this order block and continue higher. Here we swept the high, immediately retrace. There's no conviction going higher. We disrespect the fair value gap. We retrace very deep back into the order block. We disrespect mean threshold right here. So that's the first indication that price might want to go lower. Once we see this, we see price trades higher above this high. It immediately retraces. If price wanted to continue the bullish order flow, this low would have likely held and it would have pushed price higher. And it didn't do that. All the things indicate that bearish order flow might take over. Now we've seen bullish order flow fail, but bearish order flow hasn't been established yet. We can't just take the sells here and anticipate that we're going lower. It could have pushed higher even here. Now for us to confirm that we're going to go lower and likely trade to the drawn liquidity, we want to see bearish order flow start to hold. So, and for bearish order flow to start holding, we want to see the premium arrays hold. If the premium arrays want to hold, which premium array should hold here? Initially this daily SIBI, this fair value gap, we traded back into the rejection block here. Then we rejected off of it and continued lower. So the first premium array that held and didn't get disrespected was this rejection block. Then came lower, then the second one was this daily SIBI as well. The fair value gap got traded into, rejected immediately, continued lower. Then we came into the order block and bearish order flow is established. So if we quickly go over it again, what exactly happened? The first thing that we established was a draw on liquidity. Draw on liquidity is nothing without the reaction and the willingness of price to go to the draw on liquidity. So if our draw on liquidity is on the bearish side, like it was here, then we want to see order flow start to go bearish, which means bullish order flow, we want to see fill. Now, as soon as we had no conviction going above this high, so it didn't go higher with conviction like it did here. For example, here it went above the high with conviction, retraced a bit and went higher. We immediately retraced after taking the high. We retraced very deep back into the order block, disrespecting the mean threshold, disrespecting the fair value gap, indicating that price might want to go lower. Now to confirm that it wants to go lower, we waited for the bearish order flow, which means the premium arrays to hold. As soon as we saw that the first rejection block held, then we went lower. This is already a confirmation of the bearish order flow. Then the second premium array right here held and we continued lower. Then we can take all the sells here with confidence. As soon as we take this low, we might see a little bit deeper retracement into the weekly fair value gap like we talked about here. We want to see it trade back up into here, this fair value gap overlapping with the breaker mean threshold. And we would love to see it continue lower from here. If it doesn't do that and disrespects the fair value gap and disrespects the mean threshold of the breaker here, we would have the same situation as here, where we retrace very deep back into the order block, disrespect it, and there's no conviction going higher. And in this case, no conviction going lower. So we have our invalidation point of the bullish order flow here and the bearish order flow here. Then we want to see the opposite order flow hold. If we want to see higher prices here, we want to see bullish order flow start to hold, so the discount arrays to hold. And then we want to see conviction going higher above every high. So now let's take a look at the rejection block here and the daily SIBI here on the 15-minute time frame and see if we can apply the same logic that we did on the daily for the monthly SIBI and see if we can see the same thing on the 15-minute. We drop down into the 15-minute. Here we have the daily rejection block to the left. We are here on the 15-minute. Bullish order flow is here. Now, an important thing to confirm any premium or discount array, in this case premium array, this is the start of the premium array, the open of the premium array. If we want to confirm the premium array, on in this case the 15-minute, we want to see price displace back down underneath the open of the premium array. So what do I mean by that? If you see here, we trade higher into the premium array. If we traded higher like this above the premium array and did something like this with displacement to the downside, I wouldn't have taken it. Why? Because we're still above the premium array open. To confirm the premium array, we want to see it displace back down underneath the premium array. This is a sign of rejecting the premium array. So we get the first displacement here, then it fails here. Then what happens here? It's fractal. It's all the same stuff. We trade above the high without any conviction. We immediately retrace very deep back into this order block. We disrespect this fair value gap. We disrespect the mean threshold of the order block. Price starts to go lower. We can react accordingly. Now order flow might be switching bearish. We want to see the order block here hold to confirm the bearish order flow. It holds. We displace back underneath the open of the rejection block. Then here we trade lower. Now if you take a look at the daily SIBI we talked about and look at it at the 15-minute perspective, we can see bullish order flow here. It's also equal highs on the 15-minute with the daily SIBI combined. Bullish order flow on the 15-minute. We trade above these high without conviction. We immediately retrace. We trade, if you see this, we trade back into this fair value gap combined with the order block. Here we have a swing failure. It's failing to go higher. The willingness of prices to go lower. Then we immediately retrace back below the equal highs and below the open of the daily SIBI, which indicates that we want to go lower. That combined with bullish order flow failing, bearish order flow is starting to hold, and then we get lower prices. Now this is how you react instead of predict, because honestly we had no idea if it wanted to go higher after taking this high. We can't know, but we can react once we see signs that it's willing to go lower. So the first sign would be an immediate retracement and displacement back down below the open of, in this case, the premium array. Bullish order flow is failing and bearish order flow is starting to hold. I'm going to try to find one bullish example for you guys. All right, we're back on the daily time frame on the bonds. We're going to take a look inside this daily bullish order block on the 15-minute time frame. So here we are on the 15-minute time frame inside this daily bullish order block. This is the open of the daily bullish order block. Now I want you to take a look for yourself first, then I'm going to immediately go over it and help you guys. So what we're seeing here, we trade into the open of the bullish order block very aggressively. We trade away and above the bullish order block immediately. Then we slowly trade back into it. No established bullish order flow just yet. Then we trade into the close of the day. We engineer liquidity here. London has a clean setup here to take out the liquidity. We trade back inside the bullish order block. Once we're here, we want to see price explode above the open of the bullish order block again. Here we can see on the first attempt there's no displacement up. This fair value gap holds like we expect. Then the same thing happens that we saw on the bearish examples. This low gets ran without any conviction. It immediately retraces. This order block gets disrespected immediately. The fair value gap gets disrespected. It pushes higher above the open of the bullish order block. Once we see that, we want to see bullish order flow getting established. Bullish order flow starts to hold right here. The breaker gets respected. The fair value gap gets respected. We push even higher. Now this is an obvious sign that it wants to go higher. We have another breaker right here, gets respected, a possible entry. We move higher, fair value gaps start to get respected, bullish order flow is established, and we can trade to the draw on liquidity, which would be initially the monthly SIBI we talked about in the beginning of the video. So I hope this was insightful. I hope you took something from it. As we said, the first thing that's important is the draw on liquidity. Once we have the draw on liquidity, we can't just take every trade to the draw on liquidity. No, we have to wait for the willingness of price, and we want to see signs that it wants to trade to the draw on liquidity. Once we have that, we can trade with confidence to the draw on liquidity. And this is exactly how you react instead of predict. If you just have the draw on liquidity and you take every trade to the draw on liquidity, you're just predicting. If you're reacting, so you have a draw on liquidity plus you're reading the willingness of price, that's when you start react, and that's when you'll avoid a lot of unnecessary losses. Hope this was insightful. Thank you for being here, and I'll see you at the next one. Thank you.